Military conflicts are typically fought with troops, tanks, and artillery, but some of the most devastating strikes executed today involve no kinetic force at all. They are launched from keyboards. When Russia invaded Ukraine in 2022, the United States and its allies did not respond by deploying battalions to the front lines. They retaliated by executing a series of digital commands targeting Russia's central bank. This animated diagram shows a massive volume of national foreign reserves. Overnight, the U.S. and its European partners froze $300 billion of Russia's national savings. They simply locked the Russian government out of its own money. The domestic fallout was immediate. Citizens rushed to ATMs to pull out cash, international supply chains stalled, and major corporations found themselves entirely unable to process basic cross-border payments. How exactly does a single government sitting in Washington, D.C. possess the absolute jurisdiction to reach across the globe and bankrupt a foreign power in a matter of hours? Washington's reach stems from the exorbitant privilege of issuing the global reserve currency. For decades, the U.S. dollar has functioned as a global utility, one that has been systematically converted into a geopolitical choke point. To understand how this system was built, we have to look back to the final phase of World War II. In 1944, delegates gathered at Bretton Woods, New Hampshire, to design a new global financial order. Because the U.S. held nearly 2/3 of the world's gold at the time, it dictated the terms. This diagram illustrates the core agreement of Bretton Woods. Dozens of nations pegged their currencies directly to the U.S. dollar. The dollar, in turn, was the only currency tethered directly to a gold bar, convertible at a fixed rate of $35 an ounce. That system held until 1971, when a dwindling gold supply threatened to run on U.S. reserves. To stop this, President Richard Nixon abruptly ended convertibility. He severed the link, leaving global currencies anchored exclusively to a fiat dollar, a currency backed entirely by government decree, rather than a physical commodity. Without gold, the dollar needed a new foundation. In the 1970s, the U.S. secured agreements with Saudi Arabia and other OPEC nations to price their crude oil exports exclusively in U.S. dollars, creating the petrodollar system. This cycle diagram maps the resulting flow of capital. Because every modern economy requires energy to function, every nation must acquire dollars to buy oil. Once oil-producing nations accumulate those dollars, they need a safe place to store them, heavily investing them right back into U.S. Treasury bonds. Pricing the world's most critical commodity in its own currency created a permanent, inescapable demand for the dollar. Every transaction for oil, whether by an ally or an adversary, reinforced a system where the United States monitors the global flow of capital. This map shows SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT is a secure messaging network connecting over 11,000 financial institutions. It does not actually hold or transfer money. It simply transmits the instructions that tell banks where to move it. In a standard cross-border transaction, a bank in Japan sending funds to a bank in Germany uses SWIFT to send a secure message. That message acts as a direct instruction to credit one account and debit another. But because the vast majority of international trade is priced in dollars, those transactions usually require an intermediary. They end up clearing through U.S. correspondent banks. A correspondent bank is a financial institution that provides services on behalf of another, foreign financial institution. This centralized routing is what makes a financial strike possible. When the U.S. government blacklists a nation, it compels SWIFT and those correspondent banks to block their messages. Cut off from the network, the targeted country can no longer send the instructions needed to move their capital across borders. Banishment from SWIFT effectively exiles a country from the modern global economy. A system built as a neutral utility for international trade functions as an active weapon of foreign policy. The speed and efficiency of the Russian sanctions sent a clear signal to the rest of the world. Seeing hundreds of billions of dollars immobilized overnight terrified other nations, prompting a scramble for defensive measures. Rival economies accelerated efforts to bypass the American financial system entirely. This process, known as de-dollarization, involves countries actively seeking ways to conduct international trade without relying on U.S. currency or Western banking infrastructure. This diagram illustrates China's alternative. CIPS, or the Cross-Border Interbank Payment System. CIPS is designed to settle international transactions exclusively in Chinese renminbi, forming a parallel network that routes capital completely around U.S. jurisdiction. The energy market is also shifting. Saudi Arabia recently chose not to renew its 50-year agreement guaranteeing oil would be sold exclusively in dollars, opening the door to accept euros, yen, and yuan for its crude exports. At the same time, the BRICS nations, an intergovernmental organization comprising Brazil, Russia, India, China, South Africa, and others, are developing Project mBridge. This initiative explores using decentralized blockchain technology to build a new financial highway immune to U.S. interference. By aggressively wielding its financial leverage, the United States has given a politically divided world a shared economic incentive to collaborate on dismantling American monetary dominance. This pie chart shows the current distribution of global foreign exchange reserves. Even with these alternative systems growing, the US dollar still commands roughly 59% of the total, keeping it far ahead of the euro and the renminbi. This situation highlights an economic paradox known as the Triffin dilemma. The country issuing the global reserve currency must supply the world with dollars to maintain stability, but doing so eventually undermines confidence in the currency itself. When those dollars are also used as a weapon, the global trust required to hold them deteriorates even faster. The United States cemented its global influence by providing the financial infrastructure the modern world relies on. But by utilizing that very infrastructure to isolate its adversaries, it is actively forging the tools that will eventually fracture its own financial empire.